Hey traders, welcome back to Smart Trading Tactics, where we break down advanced trading concepts and strategies in a simple and practical way. Today, we're diving into a hidden gem from the trading world, candle range theory, CRT. This concept has been kept relatively secret by the ICT trading community, but once you master it, you'll see your ability to predict price movements skyrocket. Candle range theory is not just another trading strategy. It's a powerful model that can give you a unique edge in the market by helping you anticipate price movements before they happen. Sounds exciting, right? But before we get too ahead of ourselves, let's walk through everything you need to know about this theory in detail. By the end of this video, you'll have a crystal clear understanding of how CRT works, why it's so effective, and how to use it in your trading strategy. As always, if you're new here, don't forget to subscribe and hit that notification bell so you never miss out on any of our future videos. Let's get into it. What is candle range theory? At its core, candle range theory revolves around understanding how each candlestick on a chart represents a range of price action. When you zoom out to a higher time frame, each candle may look simple, just a high and a low, a body and a wick. But what you're actually seeing is a snapshot of price movement over that period. Zooming in reveals much more detail about what happened within that candle. For example, let's say you're looking at a weekly candle. From the outside, it looks like a single, simple price movement. But when you zoom into a 4-hour chart, you'll see that this candle is actually made up of numerous smaller movements, all of which contributed to the final high, low, and close of that candle. In this way, every candle is a range of price action that can be broken down into smaller digestible components. The beauty of candle range theory is that it allows you to analyze how these ranges interact with market phases like accumulation, manipulation, and distribution, the three essential cycles that price action goes through. Mastering CRT enables you to understand where you are in this cycle, which can be a game changer when it comes to executing high-probability trades. To fully understand candle range theory, you first need to grasp the concept of accumulation, manipulation, and distribution, AMD. Every price cycle follows these three stages, and they form the backbone of CRT. Accumulation. This is the phase where the market is gathering orders. Price typically moves sideways, consolidating as traders on both sides of the market place their orders. You can think of this as the market building up potential energy, waiting for a breakout in one direction. Manipulation. After accumulation, the market often sees a quick spike in one direction. This is the manipulation phase. It's where the market takes out liquidity, grabbing stop losses, or forcing traders to act before reversing course. This is where many retail traders get trapped, but understanding CRT will help you avoid these traps. Distribution. Once the market has completed its manipulation phase, it enters distribution. In this phase, the price moves toward a predetermined direction based on the previous manipulation, continuing until the next accumulation begins. These phases create what we call the power of three. It's the heartbeat of the market, and it's happening every single day, across all time frames and instruments. This cycle is what drives price action, and by understanding it, you can begin to predict what the next move will be. Now that we know how accumulation, manipulation, and distribution work, let's bring it back to candle range theory. Essentially, each candle forms within the context of these three phases, and by zooming in and out across time frames, you can see how a single candle represents a larger range of price action. Here's the key. The price range between the high and the low of a candle on a higher time frame, let's say the 1-hour chart, is actually made up of smaller, detailed price movements when you zoom into a lower time frame, like the 15-minute chart. What looks like a simple movement is actually the result of several smaller ranges interacting with each other. Each time frame tells its own story. When you understand the relationship between these time frames, you can start to see patterns, such as how liquidity is taken and where accumulation or manipulation might happen next. For example, if the price has just completed the accumulation phase during the Asian session, you might expect manipulation during the London session and distribution during the New York session. This is the typical AMD model in action, but there are important variations to watch out for. As we've mentioned, The market moves in cycles, and each session, Asian, London, and New York, plays a role in this. Understanding what each session does is crucial for identifying and trading CRT patterns effectively. Asian session. Typically, the Asian session is a period of low volatility, and price tends to accumulate. This doesn't mean that manipulation or distribution can't happen, but more often than not, the market consolidates during this session. London session. London tends to be the most volatile session and is where manipulation often occurs. The price will sweep liquidity during this session, creating opportunities for those who know what to look for. Finally, the New York session often acts as the distribution phase, where the market continues the trend that was set in motion during London. Here's a pro tip. If you notice that the Asian session has already expanded significantly, don't expect the London session to manipulate the market in the usual way. Instead, it's more likely that the London session will accumulate, with manipulation happening later in the New York session. This little detail can make all the difference in your trading success. Recognizing CRT patterns. One of the most effective ways to identify CRT patterns is by using candlestick formations. Let's talk about one of the most common CRT setups, which involves a 3-candle sequence. First candle. This candle sets the range with its high and low. Second candle. The second candle sweeps liquidity by taking out the low in a bullish setup or the high in a bearish setup of the first candle. Third candle. The third candle breaks out of the range, confirming the CRT pattern. This 3-candle sequence is a simple yet powerful way to identify a high-probability CRT setup. However, it's important to note that CRT patterns aren't always confined to just 3 candles. Sometimes the sequence will involve more candles, but the principle remains the same. Bullish and bearish CRT models. The beauty of CRT is that it applies to both bullish and bearish markets. Let's break down how you can spot these patterns. Bearish CRT. In a bearish setup, the price sets a range, sweeps the high of that range, and then breaks down to the downside, indicating that distribution is about to begin. Bullish CRT. In a bullish scenario, you're looking for a candle sequence that sets a range, takes out the low of that range, and then breaks out to the upside. This sequence signals that the accumulation phase is over and the price is ready to move higher. The trick to recognizing these patterns is to keep an eye on liquidity. Liquidity pools, or areas where traders' stop-loss orders are likely sitting, are key to understanding when and where the market is likely to manipulate before making its next big move. One of the most critical aspects of using CRT effectively is timing your entries. You need to be aware of the key times when the market is likely to form CRT patterns. In the Forex market, there are specific times when price action tends to be more reliable for these setups. 1 a.m., 5 a.m., 9 a.m., 1 p.m., 3 p.m., 6 p.m., 9 p.m. These times are crucial because they often coincide with the opening of major trading sessions, which is when we see the most volume and volatility. If you're trying to identify a CRT pattern, make sure to look for these setups around these key times. To effectively use CRT, it's important to align your entry time frame with the time frame where you identified the pattern. Here's how you can think about it. If you identify a CRT on the monthly time frame, use the daily chart for your entries. If you spot a CRT on the daily chart, look to the 1-hour chart for your entries. For CRTs on the 4-hour chart, the 15-minute time frame is your go-to for entries. If you're working with the 1-hour time frame, you can enter on the 5-minute or 1-minute charts. This alignment ensures that you're not only identifying the CRT pattern, but also entering at the most opportune moment. Executing trades with CRT. Once you've identified a CRT setup, the next step is to execute your trade. Here's a step-by-step guide to help you execute your trades with precision. Identify the range candle. This is the candle that forms the CRT range. It sets the high and low of the range, giving you the boundaries you'll be working with. Wait for liquidity sweep. Look for a candle that sweeps liquidity by taking out the low or high of the range candle. This is the manipulation phase. Enter on the breakout. Once the market has swept liquidity, wait for a candle to break out of the range in the direction you're anticipating. This is your entry point. Your stop loss should be placed just below the low for bullish setups or above the high for bearish setups of the liquidity sweep candle. Target the range's midpoint or extremes. Depending on your risk tolerance, you can target either the midpoint of the range for a safer, more conservative target, or the high-low of the range for a larger profit. Let's now see examples on a live chart. Here we have 1-hour chart of United States dollar versus Japanese yen, USD JPY. Price just reacted inside this bullish fair value gap, a key area to consider. After a small rally with bullish consecutive candles, we see price at exactly 1 a.m., a key time, a bearish candle forms. This is our candle range. Firstly, we mark the high and low of the range candle. Currently, we have an order block here. This will be our new and unmitigated PD array. Let's jump to a 5-minute chart. This is the same area on 1-hour chart. This is the range candle on 1-hour chart. We cannot enter blindly just because price has swept the low. We have to wait for a change of character. Take note, we do have an order block here on the 5-minute chart. You can refine your order by using this one here. Now we can patiently wait for the price to reach this order block. This makes it a high probability CRT setup. Finally, we reach the order block. Next step, we need the change in character. Another high is formed, so we can delete this one. Okay, we have a close above candle, but we have to wait for this break to be confirmed with another close above candle. This why it's powerful to wait and follow your rules. We wait for this break to be confirmed. All right, we have now closed above, confirming the change in character. We will enter on this order block and place our stop loss just below the order block or below the previous order block. We gladly target the middle of the range candle or the extreme high of the CRT range. This one was the perfect example of CRT model. This strategy can be the best confluence to use in your strategy. Let's move on.
Let me take you back to a time when I was just getting started with trading. It was one of those late nights, staring at the charts, trying to make sense of the chaos before me. I remember the frustration, the constant feeling of missing out on trades, and the overwhelming complexity of the market. But then, after understanding the hidden dynamics behind fair value gaps, order blocks, and rejection blocks, that changed everything. First, let's dive into fair value gaps, often abbreviated as FVGs. These gaps occur when there's a significant imbalance between buyers and sellers, causing the price to shoot up or down without fully filling the space between candles. Think of it as a skipped step in a staircase. Eventually, the market wants to come back and correct that skip. Now, why are these gaps so important? Well, they represent areas where the market is likely to revisit, offering us potential entry points. It's like a magnet pulling the price back to fill that gap, giving us a chance to capitalize on the market's inefficiencies. To spot a fair value gap, you need to look at the price action between 3 consecutive candles. If the wick of the first candle doesn't overlap with the wick of the third candle, you've got yourself a fair value gap. This gap indicates a strong momentum in one direction, often driven by institutional players who leave their footprints behind. Now, let's talk about how to trade these gaps. One strategy involves waiting for the price to retrace back to the gap after a strong move. Imagine you're a fisherman, patiently waiting for the fish to return to a known feeding spot. Similarly, you wait for the price to return to the gap, and then you enter the trade in the direction of the original move. For instance, in an uptrend, if you spot a fair value gap, you could wait for the price to retrace back into that gap before going long. This approach helps you enter the trade at a more favorable price, increasing your potential profit. On the flip side, in a downtrend, the same strategy applies. When the price retraces into a fair value gap, you can enter a short position, riding the wave of the market's momentum. Next up, we have order blocks, another crucial concept that can transform your trading approach. Think of order blocks as the footprints of smart money, those big institutional players who have the power to move the market. An order block is essentially a cluster of orders, typically found at the origin of a strong price move. These blocks represent areas of supply or demand where big players place their orders, and the market often revisits these zones to pick up more orders before continuing in the same direction. To identify an order block, look for a strong price move, either up or down, preceded by a consolidation or a series of small candles. The last candle before the breakout is your order block. This is where institutional orders were likely placed, and it's a key area of interest for us as traders. When it comes to trading order blocks, the strategy is similar to fair value gaps, but with a twist. You're looking for the price to return to the order block, where you can then enter a trade in the direction of the original breakout. This is like following in the footsteps of giants. If they found value in that area, chances are it's still a good spot to trade. Let's say you spot a bullish order block after a strong upward move. When the price retraces to this block, it's a signal to go long, expecting the price to continue higher. The logic here is simple. If big players bought at this level before, they might do so again. In a bearish scenario, you would look for the price to return to a bearish order block, where you can then enter a short position. This approach aligns you with the smart money play, increasing your chances of success. If you're finding value in these insights, don't forget to hit that like button and subscribe to our channel, Smart Trading Tactics. We're committed to helping you sharpen your trading skills with actionable strategies like these. And remember, by subscribing, you're joining a community of traders who are all working towards the same goal, trading smarter, not harder. Last but certainly not least, let's talk about rejection blocks. These are powerful reversal zones where the market has rejected a price level, leading to a strong move in the opposite direction. Rejection blocks are like the market saying, "Nope, we're not going higher or lower than this." They often mark significant turning points, making them invaluable for spotting potential reversals. To spot a rejection block, look for a candle with a long wick or shadow, indicating that the price was pushed in one direction but couldn't sustain it. The market essentially rejected that level, and the price moved in the opposite direction. These blocks are often found at the end of a trend or during a pullback, signaling a potential reversal. Trading rejection blocks involves entering a trade in the direction of the rejection. For example, if the market rejects a higher price level, you might look to go short, anticipating a reversal. It's like reading the market's mood. When it says no, you act accordingly. This strategy works well in overextended markets where the price is likely to pull back. On the other hand, if the price rejects a support level, forming a rejection block, you could enter a long trade, anticipating a bounce. This is particularly effective in markets that are oversold and ready for a reversal. If these strategies are helping you see the market in a new light, make sure to like this video and subscribe to Smart Trading Tactics. By doing so, you'll stay updated with more strategies and insights that can give you an edge in your trading journey. Plus, we'd love to hear your thoughts. Drop a comment below and let us know how you're applying these concepts in your own trading. Now that we've covered each concept individually, let's talk about how to combine them for even more powerful trading strategies. Imagine a scenario where you spot a fair value gap within an order block or a rejection block forming at a key level marked by an order block. These confluences can significantly increase the probability of a successful trade. Trading is all about stacking the odds in your favor, and by using these concepts together, you're doing just that. It's like assembling a puzzle. The more pieces that fit together, the clearer the picture becomes. Let's look at a practical example. Imagine you're analyzing a currency pair, and you spot an order block from a previous strong move. Within that order block, there's a fair value gap. As the price retraces to this zone, you also notice a rejection block forming, with the market rejecting a key level. This confluence of signals provides a high probability setup, giving you the confidence to enter the trade. In this scenario, you're not just relying on one concept, but combining multiple layers of analysis to make an informed decision. It's like building a house. You want a solid foundation, strong walls, and a secure roof. Each of these trading concepts contributes to that structure, making your trading approach more robust. Let's break down a trade using this combined approach. Suppose you're trading the EUR/USD pair, and you spot a bearish order block at a key resistance level. As the price retraces, you notice a fair value gap within this order block, indicating that the market may fill this gap before continuing downward. Just as the price enters the gap, a rejection block forms, signaling that the market is rejecting higher prices. This is your cue to enter a short trade. Your stop loss would be placed just above the rejection block, and your target could be set at the next significant support level. This trade setup has a higher probability of success because you're stacking multiple signals in your favor. In a bullish scenario, the same principles apply. You might spot a bullish order block with a fair value gap, and as the price retraces, a rejection block forms at a key support level. This alignment of signals provides a strong case for entering a long trade, while increasing your confidence in the trade's outcome. Now, let me share a real-life experience where these concepts came together in a trade that I'll never forget. I have the screenshot that I kept after the trade played out. It was during a particularly volatile period in the market, with the GBP/USD pair showing erratic movements. I had been watching a key order block that had formed a few days earlier, anticipating a potential trade which was a reversal trade as the pullback ended. This was a good opportunity for me, as it was just the beginning of the trend. As the price approached this order block, I noticed a fair value gap within the zone, signaling that the market might fill this gap. Though there were some initial rejection in the gap, I still waited for a clear signal. I kept a close eye on the charts, and sure enough, a huge rejection block formed right at the gap, touching the order block and filling the remaining gap, rejecting lower prices. This confluence of signals was the green light I had been waiting for. I entered the trade, setting my stop loss just below the rejection block and targeting a significant resistant level above. The trade played out perfectly, with the market moving in my favor, filling the gap, and continuing upward. It was one of those moments where everything clicked, and it reinforced the power of combining these concepts in my trading strategy. The psychology behind these concepts. While understanding fair value gaps, order blocks, and rejection blocks is crucial, it's equally important to grasp the psychology behind these concepts. These patterns reflect the collective behavior of market participants, particularly the smart money, the institutional traders who have the power to move the market. When you trade these concepts, you're essentially aligning yourself with the intentions of these big players. For example, a fair value gap represents an area where the market moved too quickly, creating an imbalance. The market tends to revisit these gaps to correct the imbalance, giving you an opportunity to trade in the direction of the original move. Order blocks, on the other hand, are where the smart money has placed significant orders, creating areas of supply or demand. When the price returns to these blocks, it often signals the continuation of the trend, driven by the institutional orders that remain in the market. Rejection blocks reflect the market's rejection of certain price levels, often due to an imbalance in supply and demand. Recognizing these rejections can help you anticipate reversals and capitalize on them. Advanced tips for using these concepts. As you become more comfortable with these concepts, there are advanced techniques you can use to enhance your trading strategy. One such technique is using multiple time frames to confirm your trades. For instance, you might identify a fair value gap or order block on a higher time frame, such as the daily chart, and then drill down to a lower time frame, like the 1-hour chart, to fine-tune your entry. Another tip is to combine these concepts with other technical indicators, such as moving averages, Fibonacci retracements, or trend lines. These additional tools can provide further confirmation, increasing the probability of a successful trade. Risk management is also key. Even with high probability setups, it's essential to manage your risk by setting appropriate stop losses and position sizes. Remember, no trade is guaranteed, and protecting your capital should always be your top priority.
As a trader, there's nothing more frustrating than identifying what seems like a perfect order block, only to watch the price move away without ever mitigating it. It's a common scenario that can leave you scratching your head, wondering what went wrong. The answer often lies in understanding a more complex and nuanced concept: order flow. In this video, we're going to explore the depth of order flow and how it can be the missing piece in your trading strategy. By the end of this video, you'll not only understand why some order blocks don't get mitigated, you'll also gain insights into how to create a more reliable trading plan by integrating order flow analysis. If you're tired of seeing your trades fall short, stay tuned. This video is designed to change that. And if you find this information valuable, don't forget to hit that like button, subscribe to the channel, and turn on notifications so you never miss an update. Let's dive straight into today's topic. Many traders, especially those new to the concept of order blocks, find themselves puzzled when the price fails to return to an identified order block, even when the market moves in the anticipated direction. This situation can be disheartening, especially if you've spent considerable time honing your skills in spotting these blocks. However, the reality is that order blocks are just one component of the broader market dynamic. The market is influenced by a multitude of factors, including market sentiment, macroeconomic news, institutional activity, and shifts in supply and demand. These elements collectively form what is known as order flow, and without understanding this, your trading strategy might be missing a crucial element. Order blocks, while essential, represent only a snapshot of market activity. They are zones on the chart where large volumes of orders have been executed, but these zones do not exist in isolation. They are part of a larger framework that includes the overall flow of orders in the market. Understanding this flow, continuous movement of buy and sell orders that dictate market direction, can provide you with a more comprehensive view of market behavior. In this video, we'll delve into what order flow truly is, how you can identify it on your charts, and how integrating this understanding can significantly enhance your trading strategy. So, what exactly is order flow? At its core, order flow refers to the areas in the market where there is a significant accumulation of buy or sell orders, which typically precedes a substantial price movement. These areas are crucial because they often indicate the intentions of large market participants, such as institutional traders and hedge funds, who have the power to move the market. Order flow zones are typically located where the price shows a strong reaction, either by rallying sharply or plummeting, following a period of consolidation or a retracement. Order flow can be thought of as the underlying current that guides the market. It's the collective influence of all orders, both pending and executed, that drives price action. Unlike order blocks, which are specific levels on the chart, order flow zones are broader areas where a concentration of buying or selling pressure is present. These zones often coincide with critical levels of supply and demand, where market participants are most active. By analyzing order flow, you can gain a deeper understanding of market dynamics. This allows you to predict with greater accuracy where the price is likely to move next, as well as identify key levels where the market is likely to reverse or continue its trend. For example, in a strong downtrend, a bearish order flow zone may form where the price briefly rallies before continuing to fall. Inversely, in an uptrend, a bullish order flow zone might appear where the price dips slightly before surging higher. With that said, let's take a step deeper and understand how to identify order flow on the chart. Identifying order flow on a price chart involves recognizing zones where buying or selling momentum accumulates before a significant price move. These zones can be seen as areas of consolidation, where the price moves sideways before breaking out, or as retracement zones, where the price pulls back to gather liquidity before resuming its trend. To spot these zones, you need to look for specific patterns and price behaviors. For instance, in a downtrend, you might see the price form a low, then retrace upward to gather liquidity before dropping sharply and breaking the previous structure. The zone where the price gathered liquidity before its sharp drop is what we refer to as a bearish order flow zone. This represents the last buying activity before the price moved lower, indicating a strong presence of sellers in that area. It's important to note that an order flow zone is not just a single candle pattern. It's typically made up of at least two candles that show a clear transition from buying to selling or vice versa. Within this broader zone, there is often an order block, which is a more specific area where a large volume of orders was executed. However, the order block itself is just a part of the larger order flow zone and should be analyzed in that context. Why some order blocks fail to mitigate? One of the most common questions traders ask is why certain order blocks fail to mitigate. The answer lies in the relationship between order blocks and the broader order flow. An order block might represent a significant level of buying or selling interest, but if it exists outside the main order flow zone, the price might not return to it. Instead, the price is more likely to respect the broader order flow zone, which reflects the overall market sentiment and the actions of large institutional players. For example, in a downtrend, the price might reverse before reaching an identified order block because it respects the broader bearish order flow zone first. This is a crucial point to understand. The order flow zone takes precedence over the order block because it represents the last significant area of buying or selling pressure for a major price movement. Let's consider another scenario. Suppose the price retraces to an inducement zone, creates a minor pullback, and then sharply moves upward, taking out the stop losses of traders who entered at the inducement zone. After this liquidity grab, price continues upward until it reaches the order flow zone, where it then reverses and resumes its original downtrend. In this case, the order flow zone represents the last buying activity before the price dropped, making it a more reliable area to trade from than the order block alone. The role of inducement areas. Inducement areas are another critical concept ties into order flow. These are zones where large institutions create liquidity traps to lure retail traders into taking positions that ultimately benefit the smart money. Recognizing these zones can help you avoid common traps and make more informed trading decisions. For example, the price might touch an upper order flow zone and then reverse without breaking the recent structure. This creates a false sense of security for traders, leading them to believe that the trend is reversing, when in fact, the price is merely creating an inducement before continuing its primary trend. These false order blocks or flows, known as inducements, can be deceptive and are often used by large financial institutions to create liquidity. Understanding inducement areas can save you from taking trades based on false signals. Being aware of these tactics allows you to stay ahead of the curve and avoid unnecessary losses. Now let's look at a bullish example. In an uptrend, when the price breaks a previous high, the zone just before this break represents the last selling pressure before the market surged upward. This is your bullish order flow zone. The price might reverse from this zone, rather than returning to an order block, leaving traders who are waiting for a mitigation frustrated. This example highlights the importance of trading with the broader order flow in mind, rather than focusing solely on order block. Let's now move on to some real-world example. On this GBP/USD 15-minute chart, we can clearly identify several order flow zones. The first example is a bearish order flow zone, where the price rallied slightly before sharply dropping and breaking the previous low. The area where this rally occurred represents the last buying activity before the price moved lower, forming our bearish order flow zone. By entering a short trade at this zone, you could have capitalized on the strong selling pressure and set a tighter stop loss, improving your risk management. Further down the chart, another bearish order flow zone is visible near a break of structure. Here, the price retraces slightly, touches the order flow zone, and continues its downtrend. This zone offers a better entry point than the order block alone and provides a higher reward to risk ratio. These setups are repeatable across various market conditions, making them a valuable addition to your trading toolkit. In conclusion, while order blocks are a valuable tool in trading, they should be considered within the broader context of order flow. Understanding order flow gives you a more comprehensive view of the market and allows you to make more informed trading decisions. By focusing on order flow zones, you can identify better entry points, improve your reward-to-risk ratio, and ultimately achieve more consistent profit.
Most of retail traders will buy here because we had a breakout and now price has retraced. But what will happen is that price will continue lower, taking out 90% of traders' stop loss. What they do not know is that there is an order block below. This is where institution traders place their buy or sell orders. That's why today we're diving into this crucial aspect of trading.
Wow.
Here is exactly what you will learn in this video. 1. What is an order block? How to identify order blocks. 3. High and low probability order blocks. 4. High win rate order block strategy that we use. 5. Bonus checklist of order blocks that prints you money. This will help you to spot them and use them to your advantage. So let's get started. So what are order blocks? Order blocks are essentially areas on the chart where significant buy or sell orders have been placed by institutional traders. These zones represent strong support and resistance levels. Understanding order blocks can give you a significant edge in predicting price movements. Identifying order block. To identify order blocks, 1. Look for consolidation areas before a sharp move in price that makes an imbalance or inefficiency. 2. Identify last 1 or 2 down candles in up move, or 2 last up candles in a down move. 3. Mark the low and the high of the candles. That will be your zone or an order block. These zones are where institutions have accumulated or distributed large orders. These areas are also known as areas of demand and supply zones. They are usually a single or 2 candles on higher time frame. A single candle is usually an inside bar candle. If you go on lower time, it's usually a range. Let's look at an example chart. We have a bullish scenario and a bearish scenario here. This zone here will be identified as our order block or an institution entry point. Now that you know what order block are and how to identify them, to trade effectively, you must also know not all order blocks are created equal. Some have a lower probability of success. Mastering high probability and low probability order blocks will help you to avoid unnecessary losses. Let's start with low probability order blocks. Low probability order blocks typically occur in less significant market areas, like during low volatility periods, or at random price levels without strong historical support or resistance. In other words, order blocks are considered low probability when there is no momentum in the market or no strong move or displacement away from the level of support or resistance. An order block that is formed without hitting the higher time frame level are also low probability. These low probability order blocks might not have enough institutional interest or volume backing them up, making them unreliable for trading decisions. High probability order block. High probability order blocks, on the other hand, are found in key market areas. These are typically around major support and resistance levels, higher timeframe PD arrays, previous highs and lows, and during high volatility periods when institutions are most active. These high probability zones are where you can expect the price to react strongly, making them ideal for placing trades. High probability order blocks must have liquidity area in form of old low or above it or 2 relative equal lows. Tip: the candle that trades into the order block must not close beyond the mean threshold. A mean threshold is the middle or the 50% level between the high and the low of the order block. This is important because a rejection is a sign that the order block will hold or be respected. Let's continue with high probability order block. They must also break structure. Break of structure usually is a footprint indicating we are going to continue the trend. Remember, the trend is your friend. Last but not the least, an order block must be used once. If price come back to the order block again, it ceases to be high probability, as price can easily break through it. As promised, here is the checklist of high probability order blocks. Comparing low and high probability order blocks. Let's compare these side by side. On the left, we have a low probability order block, and on the right, a high probability order block. Notice the difference in market context, volume, and historical significance. High probability order blocks have clear evidence of institutional activity and are located in key market areas, making them more reliable for trading. Now, let's apply this knowledge to a real chart. I'll show you how to identify a high probability order block and set up a trade based on it. Here, we see a consolidation area before a breakout, indicating a high probability order block. I'll place my buy order just above this zone with a stop loss below it, aiming for a target at the next resistance level. To wrap up, remember that identifying order blocks can significantly enhance your trading strategy. Focus on high probability order blocks located in key market areas with clear institutional activity. Avoid low probability ones that lack significant support. Practice analyzing charts and spotting these zones to refine your skills. Thanks for watching. If you found this video helpful, please give it a thumbs up, subscribe to our channel for more trading tips, and hit the bell icon to get notified of our latest videos. Happy trading! I'll see you in the next one.